Luke, let's dive right in. Some breaking news last night from Snap, basically as a reaction to how the economy has been doing for the last few weeks. It's announced that it's going to miss its targets. And it seems that social media and FANG stocks and tech, everything seems to be down right now. Is Snap right now that canary in the coal mine that's giving us warning for what the future is to come?
Yes. In short, yes. Snap's warning shot last night was a shot heard around the world. And it is maybe the scariest thing that I've heard in a very, very long time, maybe since the emergence of COVID. Because what's happening here is Snap is... A lot of people can make fun of Snap as this kids-only application, or, they can't monetize, la-di-do. Well, that's all hocus pocus. Snap is a fantastic company led by very genius people, very bold people, very visionary people. The app has a very sticky and highly engaged user base. Yes, that user base skews young, but as that young user base has grown up a little bit, you've turned high school engaged users into working adult engaged users. So Snap is a very strong social media platform, very strong application. And the ad business is one of the fastest growing digital ad businesses in the world today, a very sizable digital ad business in the world today. And based on a lot of reports and research that we've done, that ad platform has one of the highest ROIs for consumer packaged goods and consumer brands out there in the marketplace today. So Snap is a very strong digital advertising company. And that very strong digital advertising company is now going through a sudden, rapid, and violent deceleration in their growth because of deteriorating macroeconomic conditions. Now, that by itself is spooky. 4 weeks ago, Snap said they're going to grow revenues at 20 to 25% year over year in Q2. Now, just 4 weeks later, they're saying they're not going to grow at 20%. That's a rapid, deceleration. And that's a 4 week stretch where we're losing 5, 6, 7 points of growth. Pretty wild. That by itself is scary, but throw that on top of last week we heard from Walmart, consumer slowing, Target, consumer slowing, Home Depot, consumer slowing, Lowe's, consumer slowing, TJ Maxx, consumer slowing. We heard from Abercrombie and Fitch today, consumer slowing. So we have this huge picture of a consumer slowdown going on right now. Then at the same time, you have Uber, hiring freeze, cutting costs. Robinhood, hiring freeze, cutting costs. You have all of these tech companies, Meta, doing the same thing. And now Snap is doing it as well. In addition to announcing they're going to miss Q2 targets, they said, hey, we're going to slow the pace of hiring. They've hired about 2,000 people over the last 12 months. This year, they're going to only hire about 500. So you're talking about a 75% reduction in the pace of hiring. They're going to tighten their belts. Evan Spiegel is asking all of his managers to, where you can, cut costs. So they're in ultra defense mode too. So you start connecting the dots, start painting this picture. Whoa, the consumer is rapidly slowing. Everybody's saying, all these big retail guys are saying, hey, January, February, consumer was strong. March, pretty strong. Towards the end of March, they started to slow, and it's been real slow ever since. Every major retailer has said the exact same thing. So the consumer is slowing. Now, Snap is saying, hey, because the consumer is slowing, brands that sell to consumers aren't advertising as much. So ad spending is slowing. And that's causing the advertiser, or the advertising platform like Snap, to itself cut its own cost. Snap uses things like Zoom, DocuSign, all of those things. So now spending on those platforms is going to get hit as well. So what you have to understand is that Snap's announcement doesn't just exist in isolation. It has upstream and downstream effects. And the upstream and downstream effects imply that this whole river is starting to slow dramatically. Now throw in the macroeconomic data. Today, U.S. PMIs for services and manufacturing both dropped pretty significantly month over month. Home sales, new home sales dropped 16% month over month in April. Huge drop off, missed expectations by a mile. So the macroeconomic data is also starting to weaken pretty dramatically. Again, put that into this cocktail we got going on here, and it's not pretty. It's really scary. It looks like the economy is rapidly slowing. Snap is the canary in the coal mine. You're seeing Facebook get hit hard. You're seeing Alphabet get hit hard. You're seeing Amazon get hit hard. You're seeing Pinterest, the Trade Desk, everything across the digital ecosystem, Roku, Netflix, they're all getting hit hard. This is the beginning of Wall Street starting to understand that this economic slowdown is very real. Does that mean stocks go meaningfully lower here? Maybe, maybe not. It all is going to depend on the Fed and the course of inflation. Because at any point, Powell can turn on the dovish jets and kickstart this economy and kickstart the markets, and advertisers will start spending again, consumers will start spending again, enterprise software spending is going to go up. At any point, Powell can kick those jets on. So that's the Fed put we're talking about here. But Powell's not going to kick those jets on. He's made it abundantly clear. He's not going to kick those jets on until inflation meaningfully decelerates. And we've only got 1 month in the bag of inflation decelerating. So we're going to want to see 2, 3, maybe 4 months of that deceleration before the Fed starts to actually pivot dovish, which basically means, from a macro perspective, what I think happens here is you get a pretty marked slowdown in economic activity over the next 2 to 3 months. That slowdown lessens economic demand by enough to accelerate what is already a slowing trend in inflation. So that by July or August, inflation is much lower than where it is today. That sets the stage for the Fed to take a dovish pivot by the third quarter of 2022, at which point you're going to see the U-turn materialize in both the economy and stocks. So this is pain before gain, but this 3 or 2 months of pain that we have here could be bad. It could be pretty severe because, I mean, look at Snap. It's down 40% today. That's a wipeout. And that stock was already down something like 70% from its highs before it dropped 40% today. So the damage is pretty severe, but I think there's some fabulous long-term buying opportunities in these in the market at these current levels. So we're staying constructive, we're staying bullish, but we're fully prepared for what could be a pretty messy June, maybe in July too.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.